What's up, Investomaniacs? Your boy Knight Rider here. Do you know exactly what annual percentage return you need? Yeah, I'm talking to you. How much you need to achieve a secure retirement? If not, don't worry, most people don't know, but you're in for a lucky treat because today, in this video, right here, right now, you are going to figure out exactly what annual percentage return you need to achieve a secure retirement. All right, so first let's use an average American as an example, and then we will get into you personally. The average American under the age of 35 has a measly median net worth of $11,100. Oh, being poor sucks. And by the way, this doesn't magically turn into the appropriate retirement amount. You know, like everybody says, like, oh yeah, just put your money in the S&P 500 and it'll magically turn into $5 bajillion. No, that's not really the way it works. The average person aged 65 to 74 has a sad $224,100 net worth. Have a good luck retiring on that, especially considering the fact that the majority of that net worth is probably tied up in a house, as it is with most old people, which means that the actual amount that they can invest and get a little monthly check back from dividends or what have you is going to be close to zilch. All right, so that's not even close to the $1.6 million in 2019 dollars I calculate that is needed for a secure retirement. If you'd like to know how I came up with that $1.6 million number, by the way, I'll try and have that as a recommended video at the end of this video, as well as a link in the description. And by the way, I would also recommend watching that one if you haven't seen it or done your own math on retirement. Okay, so let's go ahead and do the math for our hypothetical person. The average 30-ish year old American will have $11,100 of a net worth. Now, this in reality is probably not all a liquid net worth, but to make things easier, we're just going to assume it's a liquid net worth. By the way, for those of you unfamiliar, a liquid net worth excludes assets which can't be redeemed easily and quickly for its full value. So like your house and car, etc., these aren't included in your liquid net worth. Essentially, we have cash, stocks, money market accounts, things you can get your hands on in a couple days. That's your liquid net worth. All right, so back to the numbers. You have $11,100 liquid net worth to invest. You are 30 years old now, and you want to retire at age 70. Thus, you have 40 years of appreciation. You contribute $200 per month. Again, this is kind of just like a number that I felt most people, even who had low-paying jobs, they could still afford $200 after taxes to put into their savings for retirement. If you can't afford $200, you probably either don't have a full-time job or you just spend too much money. You got to be able to cut your spending so you can have a safe, secure tomorrow. Anyway, and we are also going to account for a 4% annual increase in that monthly contribution to account for 3% inflation and assumes a 1% real dollar contribution growth. So the first year, it'll be $200 a month, and then on year two, it'll be $208 per month, etc., going up 4% annually, compounding. Okay, now we will assume a 5-year average portfolio turnover. Now, I know some of you are like, oh, I'm not going to have portfolio turnover. I'm either just going to, invest in like the S&P 500 and I'm never going to sell it, or I'm just going to I'm going to buy and hold. A lot of people say that like, oh, I buy and hold. I invest for the long term. Okay, here's the thing. That's not the way things work in the real world. In the real world, we do not pick perfect stocks every single time. Sometimes we pick bad stocks. Warren Buffett himself, kind of lauded as the greatest investor of all time, he sells stocks. Now, he doesn't sell as many stocks as most people, but he still sells stocks because even he either A, makes a mistake, or B, didn't make a mistake, but the company just turned bad years down the road. That's sometimes what happens. Sometimes you do make a very good investment. It just over time it becomes less good of an investment and it makes more sense to get out, pay the taxes, and then get into another better company. So a 5-year average portfolio turnover is a pretty conservative turnover by today's standards. Most people have a much quicker portfolio turnover, but we're going to say 5 years. That means on average, you're buying and selling, the stocks that you have in your portfolio every 5 years. And then we're going to account for a 20% capital gains tax during that turnover period. And early on, in reality, if you're poor, you'll probably actually be at a 0% capital gains tax rate, or if you're kind of like lower middle class in terms of income, then you'll probably be at a 15% capital gains tax rate, but I prefer to stay on the conservative side when I'm kind of doing these calculations. Plus, let's be honest, there is a decent shot that the next Democratic president, whether that be 2020 or 2024, will want to raise long-term capital gains taxes to earned income tax rates. So 20% might actually end up being like way lower than what you're really going to have to pay. And as investors, that would be a very bad thing for us. At age 70, you'll need $5.216 million to retire somewhat securely. I know that sounds like a lot of money just to retire, like $5.2 million. I thought I needed like $1 million. Yeah, that's where that inflation gets you. Or no, inflation, it sucks. So to achieve this, we must realize a 16.4% annual return. So that's before inflation. We're not taking into consideration inflation. That's also before our capital gains taxes. This is a very strong return, but certainly within the realm of realism for an intelligent investor. By the way, that's 16.4%. If on a post capital gains tax number, that's going to be 13.1%. And then if you take into account 3% inflation, that's 10.1% post taxes and post inflation. But of course, then when you take it out again the second time at the end, you got to pay the taxes again. It kind of sucks. But the point is, those are your numbers. The big number that you're looking at is 16.4. That's for our hypothetical person who kind of is in an average situation. Now we're going to talk about your personal situation. This is the fun part. We're going to figure out exactly how much you need on an annual basis. This is pretty helpful to know as it can guide your investments. For example, you might have thought you needed an X return, but you actually need a Y return. And that can change, that can influence what types of investments you're doing. So for example, like if you only need a 7% return, you don't have to take on that much risk.
That was easy.
Conversely, if you need a 15% return, you can't just sit in ETFs or blue chip stocks. You've really got to take on some risk. All right, so let's go ahead and get started. I will help guide you through this. Again, go ahead and click that link in the description if you would like to follow along, which if you're on a computer, I would recommend you follow along. All right, so first you're going to put in $1.6 million in the base amount, or if you have calculated on your own your retirement needs, and manually calculated, I would say, not just like read some article, oh, it says I need this much money. Like if you've actually ran the numbers by yourself and you took into account all the various taxes and you took into account like if you haven't watched, I'd recommend watching the video that I did on how I came up with the taxes, because it's a pretty in-depth thing, and I found that the actual required amount is a little bit higher than what most people say you need, because I just don't think they're taking into consideration all the expenses that can really add up when you're old. And so yes, my number is a little bit more conservative. Like it assumes that, you'll need to go to a skilled nursing facility, but what do you want? Do you want to plan for, I'm just hoping I'm going to die before I get to a skilled nursing facility, or I'm hoping that I'll have family members who can take care of me or whatever? Or should you plan for the worst? And then if it doesn't happen, cool, you got a little extra money, you can like give to your kids or donate or whatever. But I'd rather have the extra money and plan that I need the extra money than need it and not have it. Okay. Next, you're going to set the interest rate to 3% yearly. Next, you are going to set your desired number of years until retirement. So if you're 30 and you want to retire at 70, that number would be 40. Or if you're watching this video was produced in 2019. So if you're watching in 2020, you would subtract 1 year. So it'd be like 39. Or if you're watching in 2021, you'd subtract 2 years. It'd be 38, etc. All right. So next, we are going to set compound interval to yearly if it's not already there, and set regular monthly deposits to 0, and then we're going to hit calculate. This will give you the nominal dollar retirement requirement, which is the case for which in this case is $5.2 million. By the way, retirement requirement, I can't say it. Requirement. That's kind of a fun little. Say that one 5 times fast. All right. So again, in this case, it's $5.219 million, but yours might be a little bit different depending upon how long you want until you're going to retire. All right, so, and then we are going to start over. Now, first, and by the way, make sure you keep that number, so like open up maybe a duplicate tab or write the number down or something like that. All right, so now we are going to start over, and this time under the base amount, you are going to put in whatever your current portfolio size is, and by the way, if you have investments elsewhere, I personally would recommend putting it all into the stock market. Like I wouldn't have anything, especially if you're young, like I wouldn't have anything in bonds or gold or none of that stuff. Like I just put it in the stock market. I mean, that's where I feel you have the best chance of having a decent return that can help you get to a comfortable retirement. But anyway, whatever your investment kind of allocation is going to be, that's what you put here. And then next, we're going to put the interest rate, just go ahead and like start it off at like 10. 10 is kind of a good place to start. Make sure it stays at yearly. And then the calculation period, you are going to set back to its original number if you ever changed it, meaning if you had subtracted like 1 or 2 years due to watching this after 2019, you're going to add back on those years and bring it back to whatever the original number is between your current age and your retirement age, and keep compound interval at yearly. Now, under regular monthly deposit, put in however much you are currently contributing into your portfolio on a monthly basis, or however much you are willing to commit to right now. So whether it be $0, $50, $100, $150, $200, $250, whatever, however much money it is, put that number right here. So again, for our kind of average person, we're estimating $200. We keep this on deposit. Also, make sure this is a number you feel confident that you are able to maintain long term. So if you have some like current money that's kind of like unstable money, I would not include that money. Just kind of have your stable money where you're like, okay, I feel like I can do this year after year after year and get this money in. And then, by the way, also like if you're like me, this is a little bit difficult for those of you who have smaller portfolios, but my personal goal was, I'm kind of fortunately there now, but like my goal in the past was to get my portfolio to a point to where it was self-sustaining off of its own growth, meaning I wouldn't need to have any additional capital inflows. It would just, I have a fair enough of a return, and that will get me to my retirement requirement. But again, if you have smaller portfolios, that's probably unrealistic, and you're going to have monthly contributions in here. If you have a monthly deposit, make sure it is marked as deposit, and flip on increased deposits. Increase deposits yearly with inflation, and I set that inflation rate to your annual increase in contributions. I would recommend 3% at an absolute minimum number. This accounts only for keeping contributions up with inflation. So in reality, it's 0 change. I would not recommend higher than 5% unless you have a very solid reason to set it higher than 5%. I think 4% is a nice average number to start with. This accounts for 1% post-inflation contribution growth, as most people's income does go up over time, but you're kind of being a little bit conservative with only 1% post-inflation contribution growth. All right, so you are going to then hit calculate and see if the final year balance is lower or higher than your retirement requirement. Now, I already did the math, so I kind of came up with, that's why mine was set to like 13.1 or whatever. But you're going to see where yours comes in, and if it comes in lower or higher than your retirement requirement, that's kind of from the previous calculation that we did. If it's lower, then you increase the interest rate. Okay, so if it's lower, then you increase this, and then if it's higher, meaning if it's higher than your retirement requirement, you decrease the interest rate. You play with this until you lock in the correct interest rate to match your retirement requirement. Once you have achieved this, you take the interest rate as a number. Okay, so let's just assume you need a 10% interest rate. You're going to take the interest rate, and then you're going to take that as a number, and then you are going to divide that number by 0.8. So in this case, 10 divided by 0.8 equals 12.5, and then you're going to turn that back into a percentage, so we're going to have 12.5. This is to account for our 5-ish year portfolio turnover and its related 20% capital gains tax. So congratulations, you just figured out your exact annual return that you're going to need on a percentage basis for a secure retirement, and you can now make more personalized and intelligent investing decisions. Great job, guys. This is your number. Whatever it is for you, that's your number. Don't forget it. Have a great day.